Have you ever wondered how you can avoid paying taxes like this guy or this guy? In today's video, I'm going to show you how you can legally not pay taxes.
Wow, look at this. Do you know what this means?
Yes, leveraging this one strategy that usually the real estate investors or wealthy people are aware of. So stick around and I'm going to share their tax secrets. Like I said, we are going to go over some of the strategies that you can leverage and avoid paying taxes on your real estate. Before we get started, let me introduce myself. If this is your first time here, my name is Stephen Prosky, and I'm a licensed real estate broker with Real Estate Kona and Compass Hawaii here in Kona. If you want to talk story or real estate, my contact information is below, and feel free to reach out to me anytime. If you are a returning guest, thank you, and I appreciate all your support. So with all that being said, let's jump into how you can legally avoid paying taxes or at least lower your tax burden significantly. Before I get started, a quick disclaimer: I'm not a CPA and I am not no siree giving you tax advice. I am only sharing information with you on how I have seen many of my clients avoid paying taxes on their real estate investment portfolio over the years. If you need or want tax advice, I highly recommend you reach out to your accountant or CPA for that information. So the first one is known as a 1031 exchange. This is a tax deferral, and with this strategy, you are swapping a real estate investment property for another one and deferring your capital gains taxes on the first property for some later date and time, instead of giving it to the IRS. So let me give you an example of how this works. Say you purchased an investment property for $900,000 a few years ago, and now it's worth $1.2 million. That is roughly a $300,000 appreciation or gain. If you decide to sell your property and not reinvest into another investment property, you are most likely going to have to pay taxes on the $300,000 gain in the tune of about 20 to 30%, and that would be about $60,000 to $90,000 going to Uncle Sugar, the IRS. But there is a great program out there that you can tell the IRS, I want to pay you my taxes, but I will do it at a later date. So you purchase, say, another property for at least $1,200,000 plus, and you can defer paying the capital gains utilizing a 1031 exchange process. Yes, you are not paying taxes on the capital gains now, but I will tell you about a potential way to avoiding paying capital gains altogether a little later in my video. The government encourages people to utilize the 1031 exchange process because you are going to generate potentially more tax dollars sometime in the future, plus your actions are stimulating the economy. Now, there are some rules to utilizing a 1031 exchange, and let's go over them. First thing, you need to know this is only for investment properties, not your primary residence. It's from one investment property to another investment property, and that is the first rule. Rule number 2, you cannot touch the money, no siree. You have to use a 1031 exchange intermediary who holds onto the profit or gain that you made by selling your property, and then they put those funds towards your next property that you are purchasing. You cannot touch that money. If you do, you will disqualify yourself from utilizing the 1031 deferred exchange process, and you will then have a tax liability. Make sure before you try to go down this road, you talk to your accountant and a 1031 exchange company first. The next step are the timelines. When you are doing a 1031 exchange, you are selling one property and buying another. Once your first property has sold and closed, you have approximately 45 days from that date to identify a like property you wish to purchase. Once you have identified a like property, you have 180 days which to close on that specific property. The next rule to understand is you need to exchange like for like properties. You are selling real estate and you must buy the same like real estate. You cannot buy a boat or a vintage collectible car instead. You can purchase a condo, a commercial building, land. When selling your property, it just needs to be real estate for real estate. And again, your primary residence does not qualify. Always check with your CPA or a 1031 intermediary regarding this matter. Last rule on this subject, you need to replace or purchase the exchange property for equal or greater than the property you have just sold. If you purchased a $900,000 property, sold it for $1.2 million, then your next property to purchase must be at least $1,200,001 more. If you don't want to put all your eggs in one basket, you can buy a few properties and split the dollar amount up. But the amount must be at least $1 greater than the property that you have just sold. Check with your intermediary to see how this structure can be set up for this type of transaction. Now that's the 1031 exchange, and now you're wondering, hey Stephen, where's that bonus you talked about in the beginning? Yes, I have to pay those taxes sooner or later unless one thing happens. You die. If you die, you can pass along those properties and proceeds to your family members or heirs, and those tax liabilities get wiped out. This is a great way to establish generational wealth, and that is why the 1031 exchange process is a great wealth building tool. Now you can also take out loans against those properties, and you will not have to pay taxes on that amount of money either. What a great strategy. This is how the wealthy get richer and don't pay taxes. The second tax benefit of purchasing real estate is to write off your interest. When you generally get a mortgage, you end up with PITI, which stands for Principal, Interest, Taxes, and Insurance. When you get a loan, you get to write off the interest annually on your taxes. Say you have a $500,000 mortgage at 6% interest, you can write off about $30,000 of interest payments annually, thereby reducing your taxes owed. Another benefit of purchasing real estate is not paying taxes. You get to write off the T in the PITI, which stands for property taxes. Just imagine if you have 2, 3, 4, or even 5 properties. You can add up all those expenses and write them off annually, lowering your tax burden. Another benefit of owning real estate as an investment, you can write off your expenses. This is again one of those strategies how the wealthy get wealthier. And the last benefit of owning any investment property is depreciation. To understand this matter in greater detail, please talk to your CPA or your accountant. Today I'm just going to give you the general idea on depreciation. The IRS puts a number on how long a piece of real estate will last. The government uses 27.5 years as a life expectancy to any specific property. And during those 27.5 years, you can depreciate the overall value of a property. Yes, do properties last longer than 27.5 years? Of course they do, because there are plenty of properties here in Hawaii that are more than 50 years old or even up to 100 years old. The government allows you to depreciate all kinds of items like the roof, flooring, windows, kitchens, and the list goes on and on and on. Say your investment property was purchased for $1 million. So using the IRS formula, you could depreciate your property $36,363 each year for 27.5 years. This, my friends, is one of the great tax advantages of owning investment real estate and not paying taxes by reducing your tax burden annually. Again, I am not a CPA, nor am I giving you tax advice, so please check with your accountant or CPA for any of these tax strategies. I hope you found this subject interesting, and if so, can you please hit the like and subscribe buttons. Greatly appreciate it. Have a good week. Look forward to seeing you next one. Aloha.